now we get into the stream war. So we've been talking about the stocks within the streaming space, and there is a war brewing. Everybody's going after everybody. New story. Verizon will give customers 1 free year of Disney Plus. So why is that important? Because last week, Apple TV gave rights to Roku to stream Apple TV on Roku. Now Disney is saying, well, we're going to take it a step further. Let's let Verizon give 1 year of Disney Plus service. Folks, the war is heating up like nobody's business. So Verizon is going to give customers 1 free year of Disney Plus service. It will give certain customers, so I wonder what certain customers are. 12 free months of the new Disney Plus service. The offering will be for all new and existing 4G LTE and 5G unlimited wireless customers and new Fios home internet and 5G home internet. So I guess that is for the certain customers. Now, let's go look at the stocks that are in that industry. We're going to start off with Apple is in that industry. All right, who else is streaming? Roku, where's Roku? Roku is right. There's Roku still. There it is. There's Roku. What else is in there? Netflix. Let's go bring up Netflix. There it is, right there. And let's go bring up Disney, which is right here. All right. And and there's Amazon. I am going to put Amazon in there because they have a streaming service as well. 1, 2, 3, 4, 5 companies are in this field for the stream war. All right, Apple. Actually, Apple is a tad bit over its value, probably considered more so fairly valued. Wow, 1781. Amazon, way over its value, but people still have the perception that it's a good company. Overall, it's making money, right? Disney, over its value. So these streaming companies, which have the perception of, hey, I'm moving over to streaming. A lot of people cutting the cable, right? And moving over to streaming, driving the stock's prices higher. A lot of these stocks are going to be considered to be overvalued. How about Netflix, 270, value of 135, overvalued. Roku, 131, and its value is $11, grossly overvalued. Now, let's go start real quick with relative values. Long term, probably you don't want to own Apple. As much as I love Apple, probably I wouldn't want to own Apple as compared to a AAA corporate bond. The bond will outperform Apple over the next 1 to 3 years. Now, on the other hand, Amazon, 1.32 on relative value. This stock should outperform the AAA corporate bond by 32%. Walt Disney is way down in the list. Look at that. So they're trying to ramp up going after who? Netflix. Relative value 0.70, where Netflix has a relative value at 1.15. The only two that should outperform the AAA corporate bonds are Netflix and Amazon. If we look at Roku, wow, it is way down there. Now, this is the first one where I want to look at earnings. Let's talk about Apple. $12.77, but they're not growing their earnings. They have a growth rate of 0%, whereas Amazon, excuse me, good earnings and growing their earnings at 33%. Any company that grows their earnings, that's exactly what you want to have happen. Look at Disney, good earnings, but they're growing it in a negative fashion, negative 5% a year, which is why they're trying to hook up with something like Verizon to bolster what they are doing. Netflix, positive earnings, growing their earnings at a clip of 26% per year, and Roku, negative earnings. The only one that has negative earnings, and they're growing it in a negative way. Roku doesn't make money. Roku, with the onset of Apple putting its streaming TV on the Roku box, should help to push it up. Way overvalued. Nothing really good going on with Roku, all right? So they're on the coattails of Apple trying to get busted up a little bit or pushed up a little bit. Let's take a look at the graphs. Let's go view the stock graph. So Apple, love the equity curve on Apple. What I don't like about Apple is look at the earnings. If the earnings is the engine that drives the stock's price higher, falling earnings should do what? Pull a stock's price down. It is clearly above the 20-day exponential moving average, moving higher. Here's today's candle. Not the right day to buy today. It is a bearish candle. Let's go to the next stock, which is Roku. Again, Roku is perception. Look at the negative earnings on the stock. Look at the negative earnings getting more negativer, going lower and lower. Roku is an interesting animal in and of itself. Currently, it is above the 20-day exponential moving average, but pulling back. But look at the negative earnings. Be careful with Roku. And again, Apple may be the catalyst that may turn it around, but we'll see how that works out. Let's go to Netflix. Woo! Netflix is losing a lot of customers. All right, Netflix is losing a lot of customers to these other services like Amazon and Apple and Disney. All right, so Netflix is losing customers, but they're still hanging in there. Remember when Netflix was the only kid on the block? It was the new kid on the block. Block. What was that? Back in something again. Was that the new kids on the block? All right, so anyway, stocks price is above the 20, moved recently below. Be careful with it. I love the earnings on it, though. Love the earnings on it, but the bleeding of the customers is going to hurt it. It's going to hurt it. All right, currently below. I would wait to see if it can get above the 20-day exponential before I went to buy it. Disney's trying to come after Netflix. All right, earnings, they're spending some money to put behind the Disney name and for the stream. They have a vault of stuff, though. They've got more content than probably all of the others put together. All right, just keep that in mind. Earnings per share is falling. The price is below. Look at the trend. But they're actively and aggressively going after Netflix. Just keep your eye on Disney, as we'll see what happens. Once it gets released, people may be cutting the cord and leaving Netflix and even coming over to Disney because they've got so much content. This is a stock definitely to keep your eye on, all right? I see the negative earnings, but the positive information that's coming out and the way it's going after Netflix could be the onset, and especially since we have a level of a low right here. Let's go see if that level of a floor can hold. And the last stock is Amazon. When they know, not only do they have the streaming, but the majority of their business comes from online sales. Actually above the 20-day exponential moving average. Love the earnings per share, but moving sideways right now. All right, moving sideways right now. A nice update today.